On Monday, yesterday, the stock market dropped by 1,000 points. The S&P 500 index was down 10.9% from its record closing high on January 3rd. Will the Fed raise rates during today's meeting, or will they wait a little longer? Did you know that China's central bank just lowered their benchmark rate and are urging the United States not to raise ours? Happy Taco Tuesday, my favorite holiday each week. We have lots of news to pack into these delicious hard and soft shells of goodness, so let's get started. In case you are not aware, there is a ton of market volatility and uncertainty here in the United States as well as across the world. Inflation has skyrocketed to new highs here, and the overall consumer sentiment is poor. So what impact will all of this have if you or someone you know are in the market to purchase or sell real estate? Don't worry, stick around and I will share some tips and feedback as we move on. So if you find this video helpful, please smash that subscribe button and click that bell to get notified. The Federal Reserve Board meets today and tomorrow, January 25th and 26th. And during their meeting, they will discuss the economy and possibly make some adjustments. China unexpectedly lowered its benchmark lending rate last week, doing so for the first time since 2020. So what does this mean for the U.S. housing market as well as your family's financial future? In the U.S., inflation is soaring out of control. Mortgage rates are climbing, and the Federal Reserve is expected to increase the Fed funds rate 4 times in 2022. So why is China all of a sudden lowering their short-term lending rate? Look, this is a warning sign because when governments and banks have to lower their rates, that means that something is wrong. There is not enough monetary transactions going on in that country or maybe throughout the world in that country's currency. So they lower the short-term interest rate or rate at which banks charge each other when lending money. This move incentivizes people and businesses to borrow money. So in case you didn't know, money is created from debt. A dollar borrowed is spent and returned to the economy. So just Google fractional reserve. That's fractional reserve banking. In the fall of 2021, China experienced a major real estate event. This event was huge and has caused a tidal wave in the Chinese economy. Evergrande is a large Chinese real estate developer, and it is at risk of defaulting on 300 billion, with a B, billion in debt. This is a huge deal as the impact of that crisis in China will impact us here at home. Remember, we just shared that China recently lowered its benchmark rate at a time when the United States is looking to raise rates maybe 4 times this year. So here's why this is important and why you should pay attention. A combination of China lowering interest rates and the U.S. increasing interest rates will increase our export cost significantly. So anything that we are exporting is going to be less profit, and it's going to reduce those profits on those exports. And who do you think pays for all of this? Correct, you and I, the consumer, and this is a big issue for the U.S. economy, jobs, as well as the cost of goods. How that impacts mortgage rates is yet to be seen. In addition to hiking rates to slow inflation, the Fed also has another lever it can pull to tighten the economy. This lever involves the Fed reducing their balance sheet of mortgage-backed securities. So in this scenario, the Federal Reserve allows bonds to fall off their balance sheet and no longer invest in them each month. Now, they've been doing this the entire pandemic. They've been buying mortgage-backed securities. So by not continuing to invest in treasury bonds, the supply of these bonds will increase and rates are going to go up. So as you can see in both scenarios, we will see and continue to see the Federal Reserve tighten the economy, fighting inflation, and in the near future, we will see higher mortgage interest rates. Also on the agenda during the Fed's meeting today and tomorrow are several important housing reports. These include new appreciation readings from Case-Shiller and the Federal Housing Finance Authority. You will also see reports on new home sales and pending home sales. Additionally, the Fed's favorite measure of inflation, the Personal Consumption Expenditure, the PCE, will be released. the market is expecting PCE to rise from 5.7 to 5.99%, maybe even 6. So PCE reveals how much households spend on immediate consumption versus saving for the future. Higher consumption levels translate into greater GDP, or gross domestic product, in the short term. But on the other hand, a higher savings rate is good for long-term economic health. So why is PCE important? The PCE price index measures the change in prices for all consumption items, not just those paid for out of pocket by consumers. So think like your health insurance cost. So whether your insurance is through Medicaid or your employer, the cost of healthcare has also increased, taking more money from everyone, including those individuals and families looking to become homeowners. So if you or someone you know is looking to purchase or refinance a home, make sure to connect us together. And also, if you have any questions or topics related to homeownership and building wealth, please ask them in the comments below. We'll see you next time on Taco Tuesday.